Welcome back, folks. This is the ICT Mentorship Midweek Review for August 12th, 2020. All right, so we have the dollar index here on the left. I'm going to go through this as smoothly as I possibly can. All right, so just so you guys remember, we were expecting consolidation, and we have had consolidation. So when we're inside of this in-market environment, you try not to look for these explosive one-directional moves that go on and on like this, or like this, or like this, or like this. It's like this. Chop. Okay? And we've had that here. So we have a consolidation market profile on the daily, and we have yet to really provide a intermediate term bias. So we have to stay within a day trader's model, okay, or scalper's model. That means we're working with 1, 5, and 15-minute charts using the market structure on an hourly chart. So basically the daily, except for our levels that we have here and previous days highs and lows, it doesn't really give us a lot of prognostication. So you need not worry about the daily. Dropping into an hourly chart, you can see we have had basically what I've been outlining: consolidation, all of this range bound consolidation trading. We have had a run higher, clearing relative equal highs, and we've moved back down into the order block here. Fair value gap traded into the down close candle here. Notice that we cleared these relative equal lows there, then traded above here. So if you study on the hourly, 15 and 5-minute chart, you'll see the things I'm talking about all the time when we go into consolidation market profiles, that you're looking to sell short above old highs and buy below old lows. In a trending environment, like for instance, if a market's bullish, we're really going to focus on just buying under old lows or buying retracements inside of a market swing higher for internal range liquidity. When we're bearish, we're focusing on selling short above old highs or selling into retracements into a previous leg down for, again, internal range liquidity. It's important to understand the stance that we have when we're looking at the profiling. So if it's consolidation, there's a paradigm shift that takes place, or it should be. When we're looking at price, we're not trying to forecast the next price leg higher on the 4-hour or daily or weekly or monthly. We are submitting to the idea that the market could potentially stay in this environment for a longer period of time than we're being willing to submit to that because of lack of patience. So what do we do here? Well, I want to bring in a tool that you learn about obviously in core content, but we haven't talked too much about, and that is the bond market. Okay, so here is an hourly chart on the bond market, and we have relative equal highs. Market runs the relative equal high, breaks down, short-term low, breaks, comes back up, rebalance, bearish order block, shifts lower, rebalance the fair value gap, breaks lower, fair value gap here, sells off. Now, what could have forecasted this move here? Listen, this is one of those moments where you have to have your notepad out, because if you don't have your notepad, you're going to miss all the heavenly glory. So we have the bond market declining here from the 6th. Okay, so the 6th of August, bonds have declined. Now, this is the futures contract price. When you study the bond market in my mentorship, I will sometimes use terms interchangeably, because my understanding is that you get the understanding that I'm going to show you here. So I'm going to clarify some things right now, because when you get to a specific lesson, and if I'm not mistaken, I think it's in month 5, I get the most emails when people go to month 5 and they'll say, hey, I think you got an error here. Because one slide says the bonds do this, and another slide says that, and it's contradictory. It's not contradictory, okay? When I'm looking at bonds, I'm looking at both sides of the same coin. So while the bond market futures contract is declining here, okay, when this price is going lower, that is actually the bond yield going up. Okay, so when bonds drop like this, that's actually a precursor that will lead to a buying scenario on the dollar, or it generally tends to do that. So why is that happening? Because if the bonds are declining, that means there's an increase in the yield. Markets seek yield. So the greenback or the dollar doesn't always happen. It doesn't happen immediately. It just gives you the underlying premise, okay, or the underlying pinnings of the market that the dollar should go higher. If it does go higher, then you have symmetry, because bonds declining is interest rates increasing. All right, so here is the hourly chart on the dollar index, and this is the 6th, okay? And you can see dollar has appreciated on the upside. Over here is the secret sauce. If I had really cool music, it'd be playing right now. Something mystical, something metaphysical. So if we look at the oh, I'm such a cornball. All right, so let me maximize this chart so you can get a better appreciation for what I'm going to show you here. This is some of that charter fire. All right, so we have the 5-year bond yield, okay, and this is the bond yield, and these are the symbols here. So if you want to pull them up on TradingView, this is what you're going to pull up respectively. So the US 10, letter Y, that's the 10-year bond yield. The 5-year is US 05Y, and then the 30-year is US 30Y. Okay, and the only thing I did was, as I plotted them, I turned them all to a line chart and just gave them different colors. So it's nothing really, whatever colors you like. I just put this up here because it was on the fly. And I want you to look at the 6th. Okay, so here's the 6th right there. Now notice the lows on the 5-year. The 5-year has a higher low here on the 6th. And so does the 10-year. But the 30-year, right in here, notice what's going on here? It went lower than this and this. This is an interest rate triad divergence, okay? This means that there's a underlying shift in the interest rate market. If you couple that with what I just outlined on the dollar, see, this is the yield, okay? If we take, let me take this here and turn that off, turn that off. All right, so this is the opposite of what was being shown here on this chart. You see that? Bond futures are dropping. That means interest rates are going up. That's what you see here. Okay, the interest rates are increasing. That is bullish for dollar. On the 6th, the dollar starts to rally up. When we have dollar underlyingly bullish, like this scenario here, but we're in a consolidation market profile, that means that we're not looking for extrapolated moves. It just gives us a little nudge for bias. That means stronger dollar. That means selling short foreign currency is the most likely scenario. So if we look at the foreign currency market from the 6th to here, okay, you can see the 6th euro declines. Okay, you notice that? So there's a perfect symmetry here, and the algorithm will deliver price based on this underlying premise. So when I'm talking about bonds, okay, it does not matter if I'm saying the yield is going down, that means the bond futures is going up. If I say bond futures is going up, that means the interest rate yield is going lower. I'm saying the same thing. Now, if those slides in month 5 cause you confusion, this teaching should clear that up real quick. All right. So anyway, that's in there, an extra charge. We'll go over to the dollar index again. All right, so we've had a appreciation on the upside. Buy side liquidity has been taken, and we're still in range bound consolidation market profile. So we did take a shallow run on the sell side liquidity here. Buy side still resides above here. So I don't know really at this moment which direction we're going to go. So I have to wait to see what London does tonight, and then maybe get some kind of bias going into New York. So it's kind of like a sit on your hands and wait type thing. And unfortunately, this is the way it is, folks. When we're in consolidation, you have to wait for more information. Let the algorithm tip its hand to you. Don't try to forecast it. Don't try to. I'm telling you, if I could tell you all the times I lost the majority of my money, live money, not demo trading, live money. When I lost the most, it was when I was pushing it really, really hard in these environments. And you've heard me probably say this multiple times, especially if you've been with me for at least a year or more. And that's why it's important to be here a full year. That's why the core content is 1 full year. You'll hear me say these things over and over and over again. It'll be in market climates like this, and it draws experience into your understanding that would otherwise not be there just because you're watching static videos that aren't really drawing out the same thing as if we're watching it week by week as we do here. All right, so drop into a 15-minute time frame, and then so again, before I leave the dollar, I don't know right now at the moment where we're going to go at the buy side or the sell side. Okay, preferably I'd like to see it make an attempt to run down below here. Why? Because we had all these highs taken out with this run, and we're back down inside the range here. So sell side liquidity is in clear and present danger. It might not go down here. Okay, and I don't have any strong convictions that it will, but if I had a gun in my head, because I have to cosign every time I'm with you all, I would feel more comfortable, is the right word, with expecting it to run down below these lows versus running the high here. Okay, why would I say that? Because let's say that the interest rate market is signaling that the bonds are going to drop in their futures market. That means interest rates are going to increase. If interest rates or the yield increases, then the dollar should go higher. But before it goes higher, it would be likely to come down here and take out the individuals that got in on this run here. They could take those out. And then if it's going to run, for a couple weeks or a month or two, then that would be the perfect scenario. If I was running dollar, that's what I would do. Okay, I would take out this low here and then just put it in an uptrending market where it just doesn't have a whole lot of retracements and just keeps pushing higher and let everybody try to keep selling it. Because that's what you go on YouTube, the dollar's crashing. It's the end of the dollar. It's going to be replaced by cryptocurrency and Bitcoin. And gold's going to do this and gold's going to do that. Well, right now, gold's taking a breather. With gold slipping lower and retracing like it is, we're not going to look at gold, by the way. You can do this on your own chart. That's going to allow the upside for dollar. Now, again, that's just me only arguing the reasons why I feel comfortable with it going down here first and then maybe trading higher. And then I have the bonds behind me and the retracement in gold. Am I saying gold's done for the year? I don't think so. I'm only saying we could probably see 94.20 on dollar. So that kind of puts it in context. I'm not looking for it to scream up to a full dollar again. All right. Because we still are in this consolidation market environment. So I'm trying to keep my cards close to my vest because I'm not good at forecasting moves outside of the consolidation market profiles. I'm not. That's not my strength. I've been very comfortable with allowing the market to tip its hand to me. I've been doing that for 27 years now, and I'm not looking to change it. It works. It allows me to be patient. It doesn't force having to know everything at all times. Okay. There's no omnipotence here. I'm not omnipotent. I don't know everything about what's going to happen in price, but in certain market profiles, it would appear so sometimes. So if we look at the euro dollar, okay, so here's the euro, and let's drop back out to a daily. And obviously I can't get rid of these right now because I have to do our lower rung delivery of YouTube commentary for the euro dollar, so those will be there for the content. But euro feels to me like this consolidation isn't done, and we might want to pop up one more time. I like 120, but will it get to 120? I don't know. Okay, I don't want to kind of force the issue inside this range. I would have been more willing to see it rally to 120 had today traded down into the fair value gap here and gone below this low, but it didn't do that. We're stuck in this range between this candle's low and this candle's high. So on an hourly chart, relative equal highs, fair value gap, price ran up to that and started to break down. This candle breaks the market structure, and relative equal lows, that's where it's going to trade to. Okay, so that's the framework that starts everything that I'm not going to talk about in the YouTube channel. Now, with this context, let's go down into a 15-minute chart. All right, so the market trades up into those highs, into the fair value gap on the hourly chart. The market breaks down, rallies back up into the breaker. Okay, we're going to look at a 5-minute chart, and you'll see the breakers more obvious in here. But we had a break above this high here and fill in on the hourly fair value gap in a consolidation market profile. Relative equal lows, sell side liquidity rests below that. So I'm expecting the market to trade down because we have a market maker sell model, and I'm trying to sell in an area of distribution or redistribution. So if we drop into a 5-minute chart, here's the 5-minute chart on euro. Breaker. So we have a low, higher high than the previous high. So this run here takes the liquidity out. It does not need to break this high. You're not going to hear me talk about that in YouTube. So very, very important. This low being taken out here is not a break in market structure because it has a lower high than this one. So I prefer the breaker, which is the low that has a high to the left of it and a higher high to the right of it. So when it broke down here, this is not a market structure break. All the multi-level marketing guys that's trying to rename my stuff, they'll get on the chart and say, hey, this is the break in market structure over here. It's not. We have a higher high here. It clears the bodies of the candles. Remember, that's the narrative. We break through that, and then when it takes that low out, that's the break in market structure. Okay, it creates a SIBI, sell side imbalance, buy side inefficiency. Market trades back up. Look at the bodies of the candles, rebalance, overshoots a little bit into this fair value gap and bearish order block, consolidates back and forth, back and forth, back and forth. When it's like this, I love showing 5-minute charts because all of this chop really screws up people that think they know what I'm doing when they don't have any idea what I'm doing. Okay, the dealing range is this low and this high. So I know it's likely to stay in here, but I'm going to work within that range to find my setup. We have relative equal highs. We have a stop run here. It breaks down and it trades right back up into the bearish order block right there. That's what you've seen on the video when I did this trade here where I went short. Right there. When it runs up into that bearish order block, I'm selling short because I know the context is fair value gap on the hourly. We're in consolidation. Sell side liquidity is where it's going to draw to. We're in a market maker sell model, and it has ran stops here and here. So I have two levels of stop run on buy side, and this short term sell stop liquidity and sell side liquidity over here. So two forms of sell side liquidity and larger pool of liquidity here. What makes it a larger pool of liquidity versus this one? How much time it stayed above, and it has 2 points. So a lot of people have sell stops below that try to catch this long. Fast forward to everyone that thinks they know fair value gap. Oh, fair value gap. This is an institutional gap. It's not an institutional gap. Traders that have been exposed to core content, they have this highlighted on their chart on Instagram. Fair value gap. And they're going to all buy right here because they see what? They see this. That's a breaker. That's bullish with a fair value gap. And if you add a Fibonacci from this low to this high, it lays right on here for optimal trade entry. If it goes down there, I'm going to be a buyer. Well, look what I was doing yesterday. I was shorting. And I was not using this little thing up here, the replay button. Okay? You can watch in that recording the candles count down. When you use the replay feature on TradingView, it doesn't show you countdowns on the candle. It just gives you the full candle at a clip at a time. Okay? And you don't get this with the replay. Okay, you can watch me do the entry, and I managed all the position and the stops all throughout the entire formation of this. Okay, I was going to take the full position from entry to exit below here and just been done with it, but I want to use the YouTube channel to instill the framework in your mind, and those that are following me that can't be in the mentorship, to pay themselves, okay, to learn to profit by taking partials. It reduces the risk. It reduces that nagging ache. I want the trade to end. Get me to my profit target. I can't get there quick enough. Okay, when you take partials, it reduces the risk. It lessens the psychological burden of being in the trade because it's painful, because you want it to be over with. Okay, especially when you're learning how to trade and you're in a trade that's panning out. You're so fearful that it's going to turn around on you. You just want it to get it over. Just get me out. Okay. Sometimes it's so painful. You want the stop loss to get hit so that way you can get out of the remaining portion. You've already banked some, but it's not enough for you. When you start trading with live funds, you'll know what that means, what I just discussed. And for some of you that are trading with live funds while you're in mentorship, that resonates a lot with you, and you're creating bad habits. If you're not going to listen, don't complain later on when the results aren't there, because you're not listening. But nonetheless, I sold short at the bearish order block inside the dealing range of this high and that low. Sell side liquidity was my first objective. You see I exited with the largest portion below that with 20 pips. The market breaks down again. It gets south of this gap and trades into this old high. So I'm buying some of it back in here, and then it reaches down into the order block right here, and you see me cover some more there, and the market goes in consolidation and then drops down again below these lows, and you see me take something off there, and the smallest remaining balance, I think it was like 25,000 leverage, which is nothing. It's $2.50 per pip, ends up getting stopped out here. Goes down a little bit lower there and then reverses. Now in the video, you see me change it to 116.99, I think it was, or something close to that. I was thinking, okay, maybe we might get a punch down a little bit deeper on here, and I can get that last balance of 25,000 off on a run down below the 117 big figure. It didn't have it. So when it stopped me out here, I was not worried about whether it was going to crash and continue. But we have a market maker sell model that starts now a market maker buy model. So consolidation, leave the consolidation, return back to the consolidation, smart money reversal, low risk buy, London, New York, and New York session optimal trade entries. BISI, BISI, BISI. OTE, OTE, OTE. We zoom in here. There you go, order block, hits it, optimal trade entry, fair value gap. That is right at the beginning of our New York session that I adopted for the YouTube channel. Let me scrunch this up because that's not working for me here. OCD is flaring. That New York session has to look like it's in the middle or it's going to drive me crazy. It's a sickness. So we have the low to high, optimal trade entry here, fair value gap. Again, same thing, just a fractal of this. This movement here is the same thing this low to this high down into here is. And this low to this high down into this low is the same thing that this is. So it's 3 optimal trade entries there on time of day. This low here is at 750, so that's your New York kill zone. If you're going to use the 8:30 news embargo to London close, 8:30 to 11 o'clock in the morning New York time, this is your optimal trade entry a la YouTube version. That model runs up in here. Now, what's this red line and what's this heavy line here? I mean, scrub back here a little bit. This is the annotations I'm going to have for the YouTube video. Okay, so there you go. You don't have anything in here that says that you have, well, that's not supposed to be here, so let me get that off of there now. I had to get that off here because that's not supposed to be on this one. So in the YouTube video, you'll see me with this markup here. The 1800 big figure, it trades up into that, runs it one more time, breaks down. There's your break in market structure. That SMS was supposed to be on our notations for the shift in market structure. Runs higher, again, above the 118 big figure. Then it becomes a breaker. But I'm not going to classify why this is a breaker and why that's not, like I just did in mentorship. So membership has its privileges. The little magnet is now blackened out because it's now dead. But I'm drawing points to it because that's what was shown in the video. And DOL is draw on liquidity, which is the vernacular that I used on YouTube channel. Optimal trade entry here. It breaks down, taking partials below old low. So this liquidity pool has been tapped. And all I'm doing is taking more partials below the mid figure, 117.50, and again trading ahead of the 117.30 level, and ultimately another draw on liquidity over here, and it's the market reversal profile, and that's it. They're not going to see anything other than that. And the London close is a time window I used to time the trade. Now they're going to glean information that's useful from that, but they're not going to get mentorship. It's not being spelled out like I did for you before we went to this slide here. I explained the mechanics over here that won't be explained in YouTube. And it's been like that for years. All the things I used to do on baby pips, the optimal trade entry, all the stuff that I never talked about, you now know. You understand what the real pinnings of the markets were around those setups. And then here we are again, running above the 1800 or 118 rather, and then clearing the buy side liquidity above those relative equal highs, the relative equal highs over here. And that's going to be it for that one. And now we're going to go over to cable. I have so many charts open, I don't know where I have my cable chart. There we are, British pound, and then we'll wrap this video up. All right, so we are in close proximity still of running these relative equal highs. I still think that that's going to happen. This is too clean, folks. It's like 3 highs, okay? And notice each one's lower. High, lower high, lower high. That's the way I'm interpreting it. To me, it just looks like it's a huge pool of liquidity. Everybody feels safe that there's resistance up there. Sell short. That's what retail wants to do. And I just really am expecting the Bank of England to slam this thing up in there, regardless of what the dollar does. So with that in mind, I have not traded cable, but we have really been held in a narrow consolidation with this pair. Very, very clear, discernible trading range. We've already swept these relative equal lows. I like getting down below here and getting into this fair value gap right there. So that could be a draw on liquidity, run that, and then look for them to try to reprice aggressively off of that. So will it happen? I'm not trading it. Okay, I'm just telling you right now, I'm not trading this. I'm not touching this pair. I don't trust it. I think something bad's going to happen with it, but you may think that that's an invitation to get in here and try to make fast buck and lots of it. You won't be listening, and if you make money, I don't want to hear about it, because I don't think that's a good decision. Okay, regardless of if it trades exactly like I just outlined, just don't do it. Okay, don't do it. Finally, 15-minute time frame. Again, really mixed day, consolidation day, and I would prefer it going lower, even though it has this weird market structures in place right now. I would like it to go down to what I just outlined on the hourly chart, into that fair value gap, and then just do an aggressive repricing. Just take it all the way back up into, and then clear the highs and get into those equal highs we showed on the hourly chart and on the daily. And that, my friends, is going to be it. I gave you a lot of probably useless information for some of you that are really stiff-necked and snooty. I shouldn't have to listen to these rants. I pay money for this. Well, that's what you're paying for. You're paying for my rants, just on a subtle delivery, not like I was on YouTube. It's meaningful, it's impactful, it's useful, and it's also community. Okay, it's just what this is here. So I want you to be aware of what we're working with, what we're dealing with, how we're overcoming it, where we are in the terms of dealing with leakers and people that have people's content copies. Okay, in other words, people that have been removed. We're seeing a lot of that right now. So it's not like there's a lot of active members. Like I said, there's a couple of them that are still supplying to Telegram and Discord rooms, but they're getting ready to get yanked too. But the market itself right now, just sit still. Okay, just be still, because we are in an environment that may stay like this for a little while. And August is typically one of the slowest technical months. It basically sucks. Okay. If you want to take a vacation from charting, this is probably the best month to do it. I don't have a lot of expectation when the month of August comes. It's just my expectations are really low, and really, really low right now. We've moved a lot. We moved like 1,200 pips in euro. That's a lot. Everybody wants to buy euro, so the market's going to cool down. And if they start to sell off a little bit, that's going to make everybody think they've topped, and then they can change the gears again, create a higher high, and then they can crash it. Then rage the dollar up into the end of the year and put the middle finger proverbially up in the face of everyone that's saying the dollar's going to crash. It could crash, but I'm just thinking like a market maker. I would do absolutely diametrically opposed to what everybody's around the world saying. I mean, if you just literally just Google dollar crash, you're going to have thousands of videos where everybody's saying the dollar's crashing. Okay. Well, if everybody's saying that, it's probably not going to crash, or at least not yet. It could do it in 2021. So again, something to think about. Not a whole lot of technicals, obviously, and I don't want to give you any enticement to get in here and start trading, because again, like I mentioned, August is very slow. This month is really technically not lined up for much at all, at least at the moment right now, at this recording on August 12th, 2020, at 10 minutes to 5 p.m. in New York time. I do not see a lot of interest. But as you've seen, there are still setups, but they are in the capacity of intraday scalping day trades. Okay, and being content with that is important, even if you don't want to be a scalper or a day trader. It's a constant reminder that there are opportunities every single day, but you have to get in alignment with what the algorithm's going to do. You can't force a swing trade in an environment like this. You can't do it. You just got to relax and take what it gives you. So that's going to be it for today. I will touch base with you again on Friday for our weekend edition of the Asset Mentorship. And a little while later on tonight, I'll throw up the YouTube version of the markup for the euro dollar trade I did yesterday. And that's going to be it. Until I talk to you on Friday, I wish you good luck and good trading.